So let's put our hands together and welcome Ed.
So today I'm going to talk about running a business. You need three skills. You need a grinding, a minding and a finding skill. So the grinding skill is to do the work that your business produces and sells to the customer. And of course you need a finding skill to bring sales in, because without sales, you don't exist. And you also need a minding skill, because it's about managing your staff, because they can cost you a lot of money if you don't manage them properly. And for most of us, we evolve, if you like. Our business evolves from a grinding point of view, and we're not trained to manage people. So we end up mismanaging them, and they cost us a lot of money. And also, you've got to manage your clients' or your customers' expectations. You don't let them manage you. And to minimise the leakage, you've also got to minimise the risk. The risks are that taxes are a big part of your business, and you can easily pay too much tax. And I'm not trying to avoid any tax, because we live in the best country in the world, and we need hospitals and schools and law and order and so forth, and that requires a certain amount of revenue to fund all that. But you don't want to pay any more than you have to. And of course, litigation. So you don't want to get sued and lose everything through a mistake you've made, or even if not through a mistake you've made, but through a mistake somebody else has made, and drag you into it. And I've seen that happen over and over again. Cover this up. The law requires me to remind you that the stuff that I'm talking about now is just of a general nature. It may not apply to you personally, so you need to really get personal advice to see whether it applies to you personally. So I just thought I'd better cover that off, because that's what the law requires me to remind you. Okay, tax. I talked about leakage, so tax and asset protection. Tax is a pretty big factor, and if I can demonstrate how big a factor, if I had $2 and I invested it and I got 100% return, so my $2 increased to $4, and the $4 then increased to $8, and $8 increased to $16, and I left it there for 20 years. Right? How much do you think I would end up with? Can I have a show of hands? Who thinks I'll have more than 500,000? Who thinks I'll have more than $1 million? Okay, so you're right. So let's have a look at the compounding effect of the effect of compounding your money. So right down the bottom, you can see 1,000, is it 48,000? Now, what about tax? What about if I took tax off? So my $2 doubled to $4, so I made $2 profit. But if I paid half of the $2 in tax, so I'm left with $1.50. So $1.50 plus $2 leaves me with $3.50 instead of $4. And it doubles again, and I lose half of it in tax again, and so forth and so forth. So let's have a look at what I'll be left with. So remember the first lot, which was 1,048,000. Can I have a show of hands? Who thinks you'll end up with less than 500,000? Less than 500,000? Can you keep your hands up? Who thinks I'll be left with less than 200,000? Less than 100,000? Okay, you're right. You're actually left with 5,356. So tax is a really important component of your business, and it's very easy to pay more than you have to. So we should pay a bit of attention to it. I call it a game of tax. And down here, there's 4 stages. So down here, if you're dealing with cash and aggressive tax planning and so forth, we call you a fool, and you'll end up in jail, right? So, or you're playing this game here with sole traders and partnerships, and you end up paying about 48% tax, and we call you a pawn. And if you're playing right up here, then you've got to have really deep pockets to fight the taxman on. The government makes the laws, and the taxman polices the law, but they interpret the law according to the way they interpret it, obviously in their favour. And then, the community, including tax lawyers, interpret it their way, and until it goes to court and the judge gets up and says, no, this is the way I interpret it, it's any man's game, and unless you've got deep pockets, you won't be able to fight the ATO. So the game that we're playing in is in this area here. The tax rate that you pay there is between 0%, like a superannuation fund in pension stage, up to a maximum of about 30%. So you don't pay any more than that. So the wrong way to do it is as a sole trader. The reason why the sole trader is the wrong way to do it is because you could pay 48% in tax, or you can get sued. So if your business is held in your name, then if someone sued you because of something that you did in the business, then your home, anything that's in your name is exposed. So you could lose your home just because a business went under and it had nothing to do with your home. So we don't have that. We don't hold it in the sole trader. The other one is a partnership. So if I if I was in partnership with somebody else, all right, and the business got sued and the liability was $800,000, if he had a house worth $1 million and I had nothing, then because we're jointly and severally liable, he'll lose his house and I won't lose anything because I've got nothing. So you're caught and jointly and severally liable with somebody else. And of course, you end up paying more tax because you're a sole trader, basically, two sole traders together. So we don't do that either. Let's quickly look at a company. Company is a separate legal entity. And the major difference between a company and an individual is that the company has a fixed tax rate of 30%. Now, a company structure, as you know, there's a director and there's a shareholder. The way people set this up incorrectly is that whilst it gives you some asset protection because the business is held in the company, and if someone sued the business, they sue the company, not you. But the laws have changed quite a bit over the years and have made the directors personally liable. So the situation is you've gone to your accountant many, many years ago when you first started your business and he set you up a company, all right? So the business at that time wasn't worth anything. So over the last 10, 15 years, it's now worth, I'm making this up, $5 million. And he issued 2 shares, one for a husband, one for the wife, and he appointed the husband and the wife as directors. Now, that share that used to be worth $2 or $2 share is now worth $5 million. $2.5 million per share, because your shares is reflective of the value of your business. And because you're a director of your company, you can get sued. So you get sued for insolvent trading. So if you couldn't pay your debts and you continue to trade, you can be personally liable for that. And if you don't pay your PAYG instalments and superannuation, then you're personally liable. So obviously that's the wrong way to set it up. Now, can I have a show of hands? Who's set it up that way? Who's got a director? Okay, so I'll show you a way to fix it. The other benefit of a company is that whilst there's a 30% tax rate, once you pay that 30% tax, it's not gone, it's not lost. It's actually sitting there in an account called a franking account. Whereas if you pay tax in your own name, it's gone. You won't never see it back. So if you pay tax in a company and somewhere down the track you've retired, your tax rate's lower than 30%, you take money out of the company as a form of a dividend, tax on that dividend is being paid at 30%. So if your personal tax rate is 20%, you'll get a 10% refund from the ATO. And it could be 30 years into the future. Or if your tax rate is 35%, you only have to pay the top-up tax of 5%. It's fantastic. You don't lose your tax. Right, so you keep that credit and you build it up and then you use it like a retirement fund where you can then start taking the money out tax-free. Now, there are some disadvantages. The directors, as I said, are personally liable for the debts and things like negative gearing is quarantined in the company. There's a lot more, but I don't have enough time to go through every detail, so I'll just skip through this very quickly. The other thing is about asset protection. The theory is that you should own nothing but you control everything. So you could be worth $10 million, but you don't own any of it, but you control every single bit of it. And that's what asset protection and the strategy that we run with. And we use things like trust. The concept of a trust is a separation of control and ownership. And I'll just quickly explain. There's 2 types of ownership. There's legal ownership and there's beneficial ownership. In most instances, if you own your own house, you have both the legal ownership and the beneficial ownership. In instances like a trust, there's a separation between legal ownership and a beneficial ownership. So if something's in my name, it doesn't mean that I actually own it beneficially. So I might be the legal owner of it, the title of the property or the company or the shares in my name, but I don't actually own it. I'm holding it on behalf of someone else. Now, I know it's a bit hard to understand. So if I didn't want the property in my own name, I can ask Johnny Smith to have it in his name. It's registered in the Land Titles Office as Johnny Smith, but there's a document that I have with Johnny Smith to say that he's holding it on my behalf. Now, there's different types of trust. The most common trust is a discretionary trust, and the discretionary trust allows you to drive the income to the lowest taxpayer, and it gives the trustee the power to do that, so you can change it from year to year. Now, there's all sorts of different types of trusts. Okay, so I won't go through each one of them, just to say that they're all used for different things. Like a superannuation is also a trust, and it's used for retirement. But the most common is a discretionary trust, and there are certain things that you don't use in the discretionary trust. For example, you don't buy a property in a discretionary trust, because if it's negatively geared, the negative geared is quarantined inside the trust. So you can't offset that negative gearing, those losses, against your wages. So in that case, you'd use a property investors trust. So we developed this, and and it's got an ATO product ruling. So we went to the ATO and got them to sign off on it. And it allows you to claim the negative gearing against your wages, so get a refund from the taxman, but it also safeguards it in a trust. So if someone sues you, you don't have any assets in your name. Okay, so I'll just use some examples. So let's say that example of you having the share in your company in your own name, and your business is now worth, $2 or $3 or $4 million. So the shares is now worth $2 or $3 million. You're a director of your company. You could get sued for whatever, insolvent trading or the rest of it. So that asset, if you like, that share is an asset that's in your name. Just like perhaps you bought your house in your own name. So you shouldn't have your house in your name if you're in business, because if you get sued, your house could be lost. So let's say that share or the house is in your name. This is how we can fix it. We then set up a trust. We call it an equity bank trust. We gift the asset across to the trust and then lend the money back to the individual and secure a mortgage over that asset. So when someone sues you, they're only after money. So if there's a huge mortgage on that asset, then generally people don't bother, because they're not going to spend money to litigate against you, and then at the end of it get nothing out of it. So that's one way to fix it, and we've done quite a few of those. And then the very last thing I wanted to share with you is just the application of the use of the trust, not just what they are, but how you use them. And here's an example. So let's say situation is Tony and Sue. Tony and Sue owns this house, and they've paid the mortgage off, and it's worth $500,000. Actually, it must be in Tasmania somewhere. It's worth $500,000. But just for the purpose of the presentation, so they own that property. It's worth $500,000. They paid it off, so they own it outright. They're thinking of, they want to upgrade to a bigger house. And the bigger house is worth $800,000. So they have to borrow $800,000 to buy the second property. And then they want to then rent out the first property. And with the rent, they want to be able to then pay their mortgage and so forth. So now they've got a loan of $800,000. Now, they're going to use the first property as security. So they go to the bank and they say, take my first property as security, and the money is provided to them. Or in fact, you've got to put both properties up security. But the first one's rented out. Now, is the interest on the loan of $800,000, is that now tax deductible? Can I have a show of hands? Yes or no? Yes? And no? Okay. The answer is actually no, because when the tax department, they don't care what property you put up as security, because that's the requirement by the bank. And as you know, the bank and the ATO, they're two different institutions. And the ATO, they only look at one thing. They looked at the purpose of the loan. Where did the money go to determine the deductibility of the interest? And in this example here, the money went to where? To the second house. Okay, so, and they're going to live in the second house, so the interest is not deductible because it's private in nature. Okay, so it's just through a clever way of using trust. So let's say, this is the last slide. Let's say Tony is the higher breadwinner. He earns most of the money. So we lend $500,000 to Tony. Tony then buys $500,000 worth of units in this trust. It's a bit like borrowing $500,000 and buying BHP shares or something like that. And then the property trust uses the $500,000 in cash and buys the property off Tony and Sue. So now Tony and Sue has $500,000 in cash. All right, Tony goes and borrows another $300,000, but the original $500,000 they got for the sale of their property, that's in cash. They put that towards their new home. So they've reduced their non-deductible debt by $500,000. He's still got a $300,000 non-deductible debt, but now we've swapped at least $500,000 from a non-deductible debt into a deductible debt. Now, the savings on that at say a 4% interest rate is about $20,000 a year. So he can now claim $20,000 a year against his taxes for as long as the loan exists. Is that cool? So the last thing I want to say, and I'll hand it back to Dale, the thing is you've got to do it not for tax purposes, but for other things. Like in this instance, Tony might be in a business and he restructured it to protect his assets. So he didn't do it to avoid tax, he did it to protect his assets, because now it's held in a trust, and then the ATO is cool with that. But if you did it to avoid tax, then there's a thing called Part 4A, where the ATO could come in and unwind the structure and penalise you for it. So you've got to be very careful in how you set it up, and if you set it up correctly and you get your paperwork correct, then there's no problems. Okay, I've just run out of time. Everyone's putting his placards up in my face, so I better hand you over. So thanks a lot. Thanks, Dale.
Thank you.